Hi everyone, welcome back. In this video, we're going over the 7 mistakes to avoid after buying crypto. Stay tuned to the end though, because on top of the 7 mistakes, we also offer 2 bonus mistakes that you may not realize affect your overall investment and chances of success. That being said, let's jump into the 7 mistakes you should avoid. Number 7. Buying high and selling low. Perhaps the first and biggest mistake that most people make is the classic buy high and sell low. Everyone knows to make money, the asset you hold has to go up in value. Yet, what a lot of people do is they see a cryptocurrency going up and up and up, and they buy it then. They get FOMO, or a fear of missing out. What typically happens next is the price will start to pull back a bit, especially if you bought the token at an all-time high when it's constantly making headlines and there is a lot of noise around it. The trick is you must be patient. Only buy when you have a strong conviction about something, not just because it has been going up. It's a much better idea to buy something when it's low or when you are in a bear market. Even if you already hold some, you can dollar cost average and buy more when the crypto is low. Or, if you really want to buy something that is going up, only buy some and invest in it several times over the course of a few weeks or months. This way, if it does come back down, you are a bit protected. This could yield a better return on your result and give you a wider and broader portfolio in the long run. Number 6. Selling too soon. If the crypto you buy does not start to slide, there is no better way to lock in that loss than by selling. Again, if you did your research and truly believe in the project, this may be a good time to buy more at a lower tax lot or cost. Whether you call it a dollar cost averaging or buying the dip, if it's a good investment, don't sell. Consider getting more. This includes selling during a crash. At some point, the token or coin will recover, and if you held on to it, you'll be right where you were before the crash. Number 5. Not staking. If the crypto you purchase is proof of stake, one of the biggest mistakes you can make is ignoring this. One of the best ways to make money trading crypto is by staking your crypto in a wallet and letting it earn you interest in the form of more of that particular coin or token. It's a lot like earning a dividend when you hold a stock, only if it happens more frequently and you don't get a fiat currency like USD, you get more crypto. If you own a coin that offers this and you don't take advantage of it, you are literally throwing money away. Number 4. Using leverage. This is more of a general trading mistake, but many people use leverage and it ends up costing them big time. Using leverage is a strategy that many experienced traders might look at, but the idea behind this is not necessarily sound, no matter what level of experience you're dealing with. This is when you borrow money to invest in crypto. There are 2 ways you can do this successfully, but both take a lot of time and experience. In fact, using leverage is one of the fastest ways to leave you with nothing. So, we highly suggest you steer as clear away from this as possible and just use traditional investment ideas like buying low and selling high. So, trying to use this advanced method should be the last strategy that anyone uses. It is a strategy that almost certainly will lead to failure if you're not careful. Number 3. No diversity. In any type of investing, it is important to have a diverse portfolio. Putting your eggs all in one basket means that if you lose that basket, your eggs are all gone. The same can be said when purchasing crypto. Buying all one crypto is not as lucrative as one might expect. That means taking the time to do your investment research and finding a couple of different cryptos that could potentially allow you to hedge your investment and be more lucrative in the long run. Typically, the best option would be to have a portfolio that includes many different cryptos. This will increase your chances of success since you'll have a wider net to cast when looking to yield returns. So, after you buy crypto, start looking for more. Number 2. Buying more than you can lose. It's tempting to jump in with both feet when you finally get up the nerve to invest in cryptocurrency, but you also have to think about the fact that there are going to be losses. So, investing everything you have in cryptocurrency may not be the smartest move. Ideally, you should only be investing what you can afford to lose. Other things in your life need money, and focus and taking away from them and putting it all in cryptocurrency is not a good idea. You are going to lose money at some point. Putting all of your money into this and not focusing on making sure you're able to meet the needs outside of this could land you in some serious hardships. So, when looking to invest, make sure you only do the amount that you are willing to lose. The last thing you want to do is have to sell off some of your holdings to pay a bill or expense. Number 1. Leaving crypto on exchanges. This is a huge mistake. A lot of first-time investors look at these crypto exchanges that are available and use them as a wallet. If you did this as an FTX customer, you could have potentially lost all your holdings. Thinking that it's safe to leave all your crypto in the exchange because they have parameters in line for security is a really bad idea. Not only could the exchange itself have issues, a third party may hack or steal your crypto if it is just left on an exchange. At the very least, transfer your crypto to a wallet like Trust Wallet, and once you start dabbling with large sums of money, it is highly advisable you move your crypto to cold storage. A lot of people say if you have your crypto on an exchange, you don't own it. The exchange does. The only thing you own is an IOU. Bonus number 1. Making decisions based on emotions. When looking to invest, you need to make sure you're doing so with data and logic. But oftentimes, the excitement overwhelms us and we make decisions off of our emotions. This can happen in the excitement of the moment, when you're seeing a return on your investment or when you fear that you're going to lose it all. Oftentimes, this means that when this happens, emotions take over and all strategies go out the window. The best way to overcome this is to remember that nothing is going to go in a straight line. Nothing is completely linear. That means getting excited over an increase or fearful when there is a decrease makes no sense. Just try to be patient and weather the storm and know that you need to react according to your goals. This means understanding whether you're looking to play the short or the long game. Bonus number 2. Buying something because it's cheap. Another big mistake many first-time crypto buyers make is looking at only cheap cryptos. A lot of times, people do this trying to find the next 100x gem. This is also a mistake. They assume that because it is cheap, it may have a shot at making them rich off just a few dollars. But you're actually more likely to win the lotto than have this happen. Instead, try getting a feel for where a project is and how much potential it has. Now, how does that compare to their competitors? Is this a potentially better project with a lower market cap? If so, that is most likely to get corrected. When this happens, the price of the cryptocurrency has nowhere to go but up. Crypto is a new way of investing that has only gained popularity over the past several years. But just like with any investment, the key to being successful is to avoid the pitfalls that come with the almost gambling-like atmosphere of the crypto trading world. Crypto is a new way of investing that has only gained popularity over the past several years. But just like with any investment, the key to being successful is to avoid the pitfalls that come with the almost gambling-like atmosphere of the crypto and trading world. We hope that by going over these different mistakes that many people make, that we can help you steer clear of them and end up being more successful when it comes to your investments in the future.